Hey everybody, I hope you're doing well today. Well, let's take a look at managed exchange rate systems, which is really the third form of exchange rate systems that we study in the IB Economics syllabus. Of course, there's fixed, floating, and managed. Managed are somewhere in between, right? They're neither fixed nor floating. So someone's managing them, and of course, the people that are going to be managing them, of course, are the central banks. Okay, so the most important thing for you to realize is in reality, there is no currency in the world that's allowed to be completely free floating. And even where governments try to be as non interventionist as possible, there will be times when the currency is subject to extreme fluctuations and the central bank or government or somebody must intervene. So let's take a look at it more closely. First off, with a definition. So, a managed exchange rate regime are those where the currency is allowed to float, but with some element of interference from the government. As I just said, there's no currency in the world that's allowed to be completely free floating. Even when governments try to be non interventionist, there will be times when they must do so. Also, frequent changes in the exchange rate, if it is completely freely floating, may cause uncertainty for businesses, which is not good for trade, and so governments will be forced to intervene in order to stabilize the exchange rate. And because of this, most exchange rates in the world are managed. Okay, the most common way of doing this is that the governments, most central banks will set an upper and lower exchange rate value and then allow the currency to float freely within that value, so long as it doesn't move out of that band. And if the exchange rate starts to get close to the upper or lower level, then the central bank will intervene in the foreign market, a foreign exchange market for its currency. And they do that. Central banks do not make the upper and lower values necessarily public for fear of speculation, but they do exist. So, as we, when you get into the next couple of videos about not about managed, sorry, about strong and weak exchange rates. Basically, what governments do is they say, okay, I'm going to take Chile, for example. Chile has a peso. In the last 4 years, it's been very volatile, but within a certain range. And the Chilean government knows exactly what's happening. So when I first moved to Chile in 2012, $1 would get you 485 pesos. Now in 2016, $1 will get you 710 pesos. So the peso got weaker by a lot, right? 485 to 710. What does that mean? It means is the Chilean government not paying attention? No, they're paying close attention. And in fact, if you look at the Chilean to dollar exchange value, it's fluctuated within, guess what, a range of around 400 to 900 over the course of the last 15, 20 years. So there's no doubt that the Chilean market, the Chilean government is watching what's going on and letting it float freely. That's good. It's good for business because remember when not remember, but when you get into what the strength of there's benefits to a strong exchange rate in that Chileans can afford products from abroad, so imports go up. But as imports go up, think about it, a strong exchange rate means that for $1 you only get 485 pesos. So exports or US interest in buying Chilean products, which would be exports, goes down because that dollar doesn't get you that many pesos. As opposed to now when the peso is really weak and that dollar will get you 710 pesos. So a US citizen would be like, "Hey, let's go to vacation in Chile because it's relatively speaking cheap." Or let's buy some things online from Chile. Okay. But of course, there's a flip side to that because if you're a Chileno and you now have an exchange rate of 710 to 1 and you want to buy some gasoline that's imported from abroad and it's priced in dollars, now that same liter of gas, instead of it costing you, let's say a liter of gas cost $1, which it doesn't, but let's say that it did, instead of it costing you 485 pesos, that liter of gas for your car costs 710. That's a huge change. So there are advantages and disadvantages of strong and weak exchange rates, and governments recognize that, and so they usually pick a range and they allow it to float freely within that range. And if they need to intervene, then check out the next video because there are government measures to intervene in the foreign exchange market. And what they're basically trying to do is keep the currency within a certain range based on the prices of other currencies. Okay, so there's the lowdown on managed exchange rates. I hope you found this video to be helpful, and we'll talk to you in a bit.